Hello all, welcome to Sand Compounding. This is Sandeep Anand. I'm starting a new series called 20 for 2030. And what does that even mean? For investors, in investing, the formula of compounding, which is very powerful, and the formula is P into 1 plus R by 100 whole to the power N. And N is an exponential factor. N is nothing but, we all know, it's a time invested, time we invest in the capital is invested in a business, or the tenure as we can call. And the tenure or longevity of our investment is very important because if we make investments in businesses that can sustain for 10 to 12 years with a good level of growth and at the right valuation, we are made home. The returns on the capital invested would be very high. Now, how do we find businesses which can run and which has such longevity of 10, 12 years, especially in today's world of disruption? Every business is getting disrupted. Erstwhile, no wonder Warren Buffett, the legendary investor, used to find businesses which are least disruptive and that can run for a long time with growth, and he called it as moat. While moat investing, I don't know if it's really that relevant in today's generation because all businesses are getting disrupted with the advent of digital and mobile and internet. Now, identifying such businesses is a very difficult task, and I have tried my best to find out 20 such businesses which can pay way till 2030, and come 2030, in hindsight, these businesses would have been great to hold for such a longevity period. Now, how do we find these businesses? I've applied the principle of inversion, which I learned from Charlie Munger, and we look forward to 2030, and when we look back in hindsight, the inversion principle, based on that, what businesses could and why those businesses could sustain till that period is what I've done. So here are such 20 stocks, and one most important thing, not in investing, not all businesses are great investments at all point of time, but most point of time. So there could be reasons being valuation is one important factor which can control the time when we enter into a business. If there are frothy valuations, our returns would be mediocre. So it's very important to identify great longevity, great businesses which has longevity and at the same time that has good growth and the right valuation. So, but this could be a blueprint or a watch list that we can use to identify, and when the correction happens or recession happens, these great businesses could be a great entry point, could give a great entry point. Hope this gets interesting as we move on. The 20 for 2030 list also includes many global companies, and one such firm is part of the list is India's largest private bank, which is HDFC Bank. Known for its wealth creation capabilities and great management at helm, it has created great wealth for the shareholders for the last 2.5 decades. Now, I'm analyzing this as a great business, maybe not from an investment standpoint if you consider the valuation, and it also could be a great investment idea. Please consult your advisors that way, but this is a great business that's part of 20 for 2030. And if you really want to understand the banking industry in India, which is predominantly dominated by public sector banks and government owned banks and state owned banks that has almost 60-70% market share, HDFC Bank has gone ahead and created its own niche and has created its leadership in the private banking with great management headed by Aditya Puri, who's stepping down of the firm. But if you really want to understand why this bank is paving way for the next decade for its growth, one has to read this book HDFC 2.0 by Tamal Bandyopadhyay, and this is a great book, great read to understand the intricacies and how the bank has transformed from a core banking and into a digital-led giant. It's becoming a digitally savvy bank with implementing artificial intelligence and robotic process automation, and also partnering with many fintechs. The fintech has revolutionized in the last couple of years the Indian industry, which has leapfrogged many of the brick and mortar banking, and especially after the implementation of cash trap, which is the demonetization, and it is becoming a more cashless economy, over the last couple of years. HDFC Bank, and it's currently valued at roughly $100 billion. It's one of the largest bank listed in Indian exchange and also has roughly around $180 billion assets as of date. Let's analyze more in detail why HDFC Bank, how it became part of 20 for 2030 list. So let's get into the finer details of HDFC Bank management, distribution networks, business segments, revenue, and all other things. Right now, HDFC Bank, as I said in the starting, it's India's largest private sector bank that operates in three key areas of business verticals, from wholesale banking, retail banking, and other areas of banking that's consolidated. They have around 50 million customers serviced through 5,100 branches and spread across 2,700 locations in India. 50% of branch outlets are in rural and semi-urban areas, whereas other 50% has been the first 20 years of HDFC Bank's establishment, that is in the proper cities and urban India. They're currently valued at market capitalization wise around $95 billion today. Now, about the management, it's a well-known story in India. It's been headed by Aditya Puri from the beginning, from the scratch, and he had steered the bank to be the best of breed in India over the last 2.5 decades. He'll be stepping down as MD CEO in 2020, which is a year away, and HDFC Bank top management is already on the lookout for the replacement. It's a top-notch board with Deepak Parekh and Mr. Aditya Puri at the helm, driving HDFC Bank to be the second largest bank from scratch. This was built just in 2.5 decades, all the way from scratch, and has created huge shareholder wealth as well through this course of growth. And over the last 25 years, they maintained strong risk management focus, strong underwriting, and high return ratios on equity. Now, the management focus ahead would be just to continue the growth, at the same time making one-stop banking system for all Indian customers' financial needs. They are presently reimagining customer experience from transactions to journeys, leveraging all the digital channels and fintech partnerships as well. As we know, fintech is deeply intruding into finer areas and rural areas and semi-urban areas in India. HDFC Bank has rightly partnered with these fintechs to take leverage the advantage from that. They have worked on creating the digital ecosystem to pave way for the future of Indian banking. Now, what does digital focus and digital transformation means, right, with this bank? Now, with the digital transformation and mobility banking, that's a team formed by this bank called DTMB. That team being at the forefront, HDFC Bank has launched a host of highly successful digital banking products. Now, some of them include 30-minute paperless auto loans processing using biometric technology. Now, this is a very important factor because in India, even today, because it's an emerging nation, there are a lot of paper-oriented applications which we can call as offline applications, and a mix of online applications as well, and most of the users were not users data were not captured. The biometrics was not available few years back, but with the unique ID implementation, so-called Aadhaar, and with all the customer data being available, it becomes even more easier to gather the customer data and process the loans completely online. And probably that's one of the initiatives they have made, this 30-minute paperless auto loans using biometric technology. Then there is a 10-second personal loan on net banking. Then there is a Payzy app. There are other fintech integrations like Chiller, LIT app. Then there is missed call recharge, that's for the mobile phone recharging, and some of the other features like instant loans at ATM. And the most important thing is the robotic assistant, the what is called as IRA, that's been introduced at HDFC Bank branches. They recently launched the first humanoid in the domestic banking space. Now they are also bringing robotic process automation, also called RPA, and trying to automate at every possible spaces in the banking area. Now, voted as India's smartest chatbot, EVA is a chat-based solution on the HDFC Bank website that enables the bank to solve basic customer queries instantly. Again, part of the robotic automation, and chat is available now across all the banks, but in India, especially in HDFC Bank website, this was voted the smartest chatbot. This is in addition to HDFC Bank's powerful net banking portal, which has been prevalent for a long time, and mobile banking, which has close to 13 million customers doing transaction online. So 1/3 of the customers are almost doing transactions online, are already migrated to the online portals. Coming to the assets and liabilities profile, It's an interesting business mix. They have total deposits split not equally, but majority being from a retail franchisee, and the other part of the deposits coming from wholesale. So their liabilities are pretty much interesting mix of wholesale and retail franchise, and the total liabilities or deposits are growing by a steady clip of 17%, and it's currently valued at $145 billion, and 80% of those liabilities are serviced from retail segments, and the cost of deposits at 5%, which is pretty much lowest in the country for comparing to other banks. High quality liability franchise with CASA, it's a term tracked closely in India. It's called current account, savings account, just to track the quality of the liability franchise. So obviously, current account, savings account, brings down the cost of liabilities or cost of capital deposits, and that's forming almost 42% of percentage of total deposits. They have around 7% share in domestic deposits, and is going to grow ahead. Now the advances, or the gross advances rather, they are growing at around 24.5 percentage, approximately 24 percentage, and it stood at around $115 billion in 2019, and they have around 8% share in total domestic advances or the loans. Now this is a very interesting mix, and the profit before tax is around, in terms of rupees, is 33,300 crores, and that's around $4.5 billion, growing by 20%, and a PAT at 21,000 crores, which is growing by 20% in FY19. Now they provides customer base for ongoing cross sell through the branches, and this is a very interesting story, because HDFC Bank always maintain a steady growth of 20 to 25 percentage between this window range, and they never went beyond, and that's precisely why they have grown cautiously with strong risk management focus, and in future as well we could expect the similar kind of growth from HDFC Bank. Let's see the net interest income, margins, return metrics, and asset quality. Now it's the comparison between year ended March 19 and March FY18, so that is financial year in India. The net interest income was 20% growth over FY18, and now the net interest income forms around 73% of revenue, which is great, and they have another 27% of revenue coming from other type of revenues like fees and commissions, forex, derivatives, all are pretty good quality other income. So overall the net revenues were growing at 19%. Now the operating cost increased by 15%, and you can see the PBT, profit before tax, grew by 20%. Profit after tax again grew by 20%. So this is the beauty of this bank's growth. They are maintaining a steady 20% growth, whether it's revenue, whether it is profit before tax, after tax, and they are controlling the cost optimally well and maintaining that margins. You could see the net interest margins at 4.3%, which is best in the industry. So they are not sacrificing the quality of growth for just to meet the numbers or growing at higher pace. So they just still want to grow at a steady clip, but at the same time maintaining the quality of the book and not getting into trouble. So that's the risk management focus and underwriting focus they are having, the management is having. That can be seen in the right side, the NPA, which is a measure tracked in India. It's called non-performing assets, as a percentage of to the advances. It's minuscule compared to other banks. It's around 1.36, which is the gross, and net at 0.39%. Now this is very interesting, especially in the last 2 to 3 years India has seen a tremendous increase in the non-performing assets across banks, and it started all the way back to 2012 to 2013, and it's increased, accentuated towards the last couple of years. And now while all the bankruptcy and the recoveries are going on, you can see how HDFC Bank has come out unscathed through these overall issues that other banks have been facing. Now the asset quality, which is a combination of wholesale and retail, is best in the industry. Specific provisional coverage at 70% of net non-performing assets, which is great, and a total coverage ratio of about 117%. They have been maintaining strong return ratios, not much moving around. It's around 19 to 20%. It's a little lower in FY19 at 17%. The return on asset at 2% consistently over years. So this has been the consistent growth story for HDFC Bank. Now, why I think HDFC Bank will still be a great business to hold in hindsight when we look back in 2030. This is a very statistical comparison that I've done across the countries, the similar large economies, and you can see the top 5 largest US banks holds assets equivalent to 50% of US GDP for around $20 trillion. Now US GDP is $20 trillion. You could see, add up the top 5: JP Morgan Chase at $2.75 trillion, Bank of America at $2.39 trillion, Citigroup 1.9, around $2 trillion, Wells Fargo around $1.9 trillion, Goldman Sachs at $925 billion. So you add up all, it forming 50% of US GDP. Let's take China. The top 5 largest state-owned banks in China forms around 110% of the GDP. That's even more than the GDP of $12 trillion. Now look at the Industrial and Commercial Bank of China. That's around $3.7 trillion. China Construction Bank CBC, which is at $3.1 trillion. Agricultural Bank of China, $3 trillion. Bank of China, $2.7 trillion assets. Bank of Communications, $1.3 trillion. Now add up, it's even more than the GDP. It's more than $13 trillion. Now India's top 5 banks assets as percentage of GDP is 42% as of date. State Bank of India, it's around $500 billion. HDFC Bank, $180 billion. ICICI Bank at the same level, $183 billion. Bank of Baroda, that's $130 billion, and Punjab National Bank at $110 billion. Put together, they form 40% of the GDP as of date. And if India achieves the so-called growth strategy for India's economy, which is 5 trillion GDP by 2025, which is aspired by the government as well as the Economic Advisory Group, if they are able to achieve anywhere close to that, the considering banks are going to create the credit growth and support the credit growth, and asset size would grow at the same time. It would form at least 50% of the GDP, which means the top 5 banks assets should be at least around $2.5 trillion roughly, and which is 2.2 times the current size. And just on sheer asset growth due to economic growth, HDFC Bank can grow assets roughly 2.5 times from current value by 2025. Now this is a snapshot view in continuation why I think it would have been a great business to hold in hindsight. So the first point is, now as I said, 2.5 times the assets of current base growth just due to sheer Indian economic growth, plus the market share grab from public banks drifting by another 10% upside, overall will force multiply the further asset growth in the next 10 years. Now we are looking at a factor order of magnitude of 8 to 10 times of market capitalization growth over the next 10 years due to these multitude of factors. Now rural and semi-urban focus of the banks is in the right direction. That could grow much faster than the urban banking. That's evident from the results due to the financial inclusions, or even more inclusions, and digital highway penetration. Management is known for its risk management and efficient credit portfolio analysis carried out at periodic intervals of their loan books through loan review, credit audits, etc. Now all the audits and checks and balances are in place. The assets mix targeted to be diversified across industries and across retail wholesale mix. Technology advancement has been well integrated to benefit from digital explosion in India. Now all the emerging nations, one common trend that we can see is the fintech explosion. At the same time, they are leapfrogging many of the financial inclusions directly through the digital pathway. Now opportunity for private banks remains buoyant considering the economic revival, gaining of market share from the state-owned banks that's in India, and the crisis situation that's prevalent currently in non-banking financial companies, which are the shadow banking system in India, and also through the retail financial inclusion growth. The total market itself is growing at as faster as Kotak Mahindra Bank, which is one of the largest private sector bank in India. That bank's head Uday Kotak, one of the most respected banker in India, has predicted in one of the conferences that the private bank's market share will increase to almost 50% from the current 30% market share over the next 4 years. Now that's a strong sectorial tailwind for HDFC Bank and even other private sector banks to grow, and they would maintain their growth trajectory in the next decade.